Listen carefully, because what I'm about to explain is not something most investors are prepared to hear. Right now, the majority of people looking at silver are still focused on the wrong signals. They are watching short-term price action. They are reacting to daily fluctuations. They are waiting for confirmation before they make a move. But I need you to understand something clearly. What is forming in the silver market right now is not a short-term opportunity. It is not a temporary reaction. It is not driven by speculation. This is a structural shift. And structural shifts do not announce themselves in a way that feels comfortable. They do not arrive with consensus. They do not wait for everyone to agree. They build quietly beneath the surface while most participants remain anchored to outdated assumptions. Then, at a certain point, the shift becomes visible. But by then, the most important phase is already behind us. This is exactly where we are right now. I am not talking about a minor correction. I am not talking about a routine cycle within a stable system. I am talking about a developing imbalance that has historically led to aggressive repricing events. And history has shown this again and again. These moments never begin with clarity. They begin with subtle changes in behavior that most people ignore. Most investors still treat silver as a secondary asset, something passive, something that sits quietly in a portfolio as a hedge, something that only matters when uncertainty spikes temporarily. But that framework is starting to break down. Silver is no longer behaving like a background asset. It is beginning to reflect deeper stress within the financial system itself. You need to understand what that means, because when an asset shifts from being passive to being reactive to structural pressure, it changes its role entirely. It becomes a signal. It becomes an indicator, and eventually it becomes a driver. The real question is not whether silver can move aggressively. It has done that many times before. The real question is why the conditions are aligning again in a way that makes a major move increasingly likely. And when you examine the structure carefully, the answer becomes difficult to ignore. Let's start with supply. Silver supply is not flexible. It does not respond quickly to rising prices. It cannot suddenly expand when demand increases. Production is tied to long development timelines. It is constrained by regulatory barriers. And most importantly, a large portion of global silver production comes as a byproduct of other mining operations. That means even if silver demand increases dramatically, supply cannot adjust in real time. It is locked, it is rigid, and rigidity is where pressure builds. Now look at the other side of the equation. Demand. Demand is not just increasing. It is becoming structural. This is critical. The modern global economy is transitioning towards systems that require silver at scale. Electrification, renewable energy, advanced electronics, data infrastructure. These are not temporary trends. These are long-term transformations. Demand is expanding independently of price. So now you have a situation where supply is constrained and demand is persistent. That imbalance does not resolve smoothly. It accumulates. It builds beneath the surface, and eventually the market is forced to respond. This is how every major repricing phase begins. But there is another layer that most investors are completely missing. Markets are not driven only by physical supply and demand. They are driven by capital flows, and capital does not move randomly. It responds to changing conditions across the entire financial system. For years, capital has been concentrated in financial assets, equities, bonds, growth sectors. These assets benefited from a very specific environment. Low interest rates, abundant liquidity, confidence in central bank policy. That environment encouraged risk-taking. It rewarded leverage. It created the perception of stability. But that environment is changing. Global debt levels have reached extreme levels. Governments are operating with persistent deficits. Corporations depend on refinancing. Consumers rely on credit to maintain purchasing power. This entire system depends on the ability to roll debt forward continuously, and that works until it doesn't. When interest rates rise and liquidity tightens, pressure begins to spread across the system. This is not theoretical. This is mechanical. And once that pressure begins, capital behavior starts to change. Not all at once. Not dramatically at first, but gradually institutional investors begin adjusting exposure. Hedge funds start increasing allocations to real assets. Central banks begin reinforcing reserves with tangible stores of value. This is how transitions begin quietly, and this is where silver becomes critically important, because silver sits at the intersection of two powerful forces that rarely align at the same time. It is both a monetary asset and an industrial input. When financial systems come under pressure, monetary demand increases. When technological systems expand, industrial demand increases. Silver responds to both. That dual role creates sensitivity. It means silver does not need extreme conditions to move. It needs alignment. And once that alignment begins, the response can accelerate very quickly. This is why silver does not move in smooth, predictable trends. It moves in phases, long periods of quiet behavior followed by sudden, aggressive moves. And when those moves begin, they do not wait for late participants. Most investors are not prepared for this type of behavior. They are conditioned to wait for confirmation. They want stability before they act. They want validation before they commit capital. But you need to understand something very clearly. Stability exists before the shift, not during it. During the shift, volatility increases. Price becomes less predictable. Movement becomes uncomfortable. And that discomfort is not a sign that something is wrong. It is a sign that something is changing. This is where repricing comes into play. Markets do not adjust gradually when imbalances become too large. They reprick. They move from one level of equilibrium to another. And that movement is often faster than most people expect. Silver has done this repeatedly throughout history. It remains quiet while pressure builds. It absorbs supply. It tests resistance. And then once the structure changes, it accelerates. Not slowly, not politely, decisively. This is the phase that demands attention, because once the market begins to recognize the imbalance, the process does not slow down to allow everyone to reposition. It moves forward driven by those who understood what was happening early. And this is why timing matters. Not in the sense of predicting exact price levels, but in recognizing when conditions are aligning. Because right now, those conditions are aligning. Supply constraints, structural demand, shifting capital flows, and increasing stress within the global financial system. These are not isolated factors. They are interconnected. And when multiple forces begin moving in the same direction, the probability of a significant shift increases. The real question is not if this resolves. The real question is how fast. Now, I want you to step back and look at the broader system, because this is where most investors fail to connect the dot. Modern financial systems are not built on stability. They are built on expansion of credit, expansion of debt, expansion of liquidity. Governments issue debt to sustain spending. Corporations rely on debt to grow and refinance. Consumers depend on credit to maintain their standard of living. This entire structure functions efficiently under one condition: borrowing must remain manageable. But that condition is no longer stable. Interest rates have moved higher relative to the previous cycle. Servicing debt is becoming more expensive. Refinancing is becoming more difficult. And as this pressure spreads, it begins to expose something deeper: fragility. I am not speaking in abstract terms. This is a structural reality. When debt levels reach a point where they cannot expand without consequence, the system begins to strain. And once that strain appears, policymakers are forced into increasingly difficult decisions. They can tighten policy to control inflation, but that increases stress across debt market. Or they can loosen policy to stabilize the system, but that risks weakening currencies and extending inflationary pressure. There is no clean solution, and that is exactly where uncertainty begins to grow. You need to understand this clearly. Uncertainty is not just a feeling in the market. It is a catalyst for change in capital behavior. When confidence in the system begins to weaken even slightly, capital does not remain static. It starts to move. At first, the movement is subtle, almost invisible, small relocations, slight shifts in positioning. But over time, those movements become more defined, more deliberate, more aggressive. Capital begins to search for alternatives. Not speculative alternatives, but structural ones. Assets that are not dependent on policy credibility. Assets that can hold value independently of financial engineering. Assets that are tied to real demand. This is where silver begins to change its role again, because silver does not rely on the stability of the financial system to justify its value. It does not depend on central bank credibility. It does not require confidence in sovereign debt. Its value is rooted in two things, scarcity and utility. And that combination becomes extremely important when the broader system begins to show signs of stress. But I want you to go deeper than that. Silver's industrial role is not optional. It is foundational. The modern economy is increasingly dependent on technologies that require high-efficiency conductivity, electronics, renewable energy systems, telecommunications infrastructure, advanced medical applications. These are not cyclical industries that disappear during downturns. They are long-term structural pillars of economic development, which means demand for silver is not tied to short-term economic cycles. It persists even during slowdowns. It continues to exert pressure on supply. And when supply is already constrained, that pressure does not disappear. It builds. This is exactly what we are seeing right now. Mining output is not scaling fast enough to meet long-term demand. Development timelines are extended, regulatory environments are restricted, costs are rising, and because silver is often produced as a byproduct, production decisions are not even directly tied to silver prices. This creates a system where supply cannot respond efficiently. And when supply cannot respond, imbalance becomes inevitable. Now combine that with another critical factor that most investors overlook, market size. The silver market is small, extremely small compared to global equity and bond markets. That means it does not require massive capital flows to create significant price movement. Even modest relocations from large institutions can have an outsized impact. This is where most people misunderstand how markets actually move. They assume that large price movements require large events. But in smaller markets, that is not true. All it takes is aligned capital flow. When capital begins to shift into a small market that already has structural imbalance, the result is not gradual movement. It is acceleration. This is why silver has a history of sharp, sudden advances. It does not move in a controlled linear fashion. It reprices when the structure demands it. And this is where psychology becomes critical. Most investors are conditioned by recent history. Years of sideways movement have created skepticism. Many have dismissed silver as underperforming, irrelevant, unreliable. That skepticism creates something very important, low resistance. When momentum returns to a market that has been ignored, there is very little opposition. There are few participants positioned early. There is limited supply available at lower levels. And that creates the conditions for rapid movement. But psychology does not shift all at once. It evolves. First there is disbelief, then doubt, then curiosity, then participation, and finally urgency. That progression happens in every cycle. And right now we are still in the early stages. This is where timing becomes critical again, because the most favorable conditions do not exist when everyone agrees. They exist when uncertainty is still present, when skepticism still dominates, when the majority has not yet committed. Once participation becomes widespread, price adjusts quickly, and at that point, investors are no longer positioning. They are reacting. This is not theoretical. It is a pattern that is repeated across every major silver cycle. Long periods of neglect followed by sudden recognition. Quiet accumulation followed by rapid expansion. Skepticism transforming into urgency. And every time the early phase was where the real advantage existed, because early participants operate with flexibility. They can scale positions gradually. They can manage volatility with discipline. They can think strategically. Late participants operate under pressure. They chase movement. They react emotionally. They make decisions based on price rather than structure. And that difference defines outcomes. This is why I am telling you that the focus should not be on exact price targets. Whether silver reaches a specific number is not the most important point. The real importance lies in understanding why those extreme scenarios are even being discussed, because they are not emerging from speculation alone. They are emerging from structure-constrained supply that cannot adjust quickly. Persistent demand driven by long-term industrial transformation. Capital that is beginning to reposition, and a financial system that is showing clear signs of strain. These are the conditions that precede repricing, not gradual adjustment, decisive movement. And once that movement begins, it does not unfold in a way that gives everyone time to prepare. Markets move ahead of awareness. They always have, and they always will. And this is where the final layer becomes unavoidable, because once you fully understand how these forces interact, you begin to see something much bigger than a simple market opportunity. You begin to see a system in transition. Listen carefully. I am not saying this lightly. Every major financial cycle reaches a point where the mechanisms that once supported stability begin to weaken. Debt expansion becomes less effective. Policy tools begin to lose precision. Confidence, which once appeared solid, starts to shift gradually beneath the surface. And during that process, certain assets begin to behave differently. They stop reacting to surface-level information. They stop moving in line with traditional expectations. Instead, they begin to reflect deeper stress forming within the system itself. Silver is entering that phase. It is not moving because of isolated events. It is not reacting to temporary headlines. It is responding to multiple structural forces that are aligning at the same time. And when that kind of alignment occurs, markets do not adjust slowly. They adjust decisively. This is where most investors hesitate. They are conditioned to wait. They want confirmation. They want validation from analysts, institutions, or media narratives. They want the move to feel justified before they act. But you need to understand something clearly. Markets do not reward that behavior. The early stages of every major shift are defined by uncertainty. They feel incomplete. They create doubt. And that doubt is not a flaw in the process. It is the opportunity, because by the time uncertainty disappears, the repricing is already well underway. History has proven this again and again. Silver's most powerful advances did not begin with consensus. They began with skepticism. They developed through disagreement, and they accelerated only when the imbalance became impossible to ignore. That sequence is unfolding again. But what makes this cycle different is the scale. Global debt has reached levels that constrain traditional responses. Governments are operating with persistent deficits. Central banks are navigating an environment where every decision carries consequence. Currency systems are under pressure not only from internal policy decisions, but also from external geopolitical shifts. These conditions not resolve quickly. They evolve. And as they evolve, capital adapts. It does not move all at once, but it does not remain still either. It begins to reposition toward assets that can function independently of policy constraints. Assets that preserve value when confidence fluctuates, assets that reflect real economic demand. Silver fits that profile. But what makes silver uniquely important is its sensitivity. It is smaller than gold, more reactive, more volatile, and that volatility is often misunderstood. Most people see volatility as risk, but in reality, volatility is information. It reflects how quickly an asset is responding to changing conditions, and silver responds faster than most. It reacts to shifts in capital flow earlier. It reflects changes in perception sooner. It begins to move before the majority of the market fully understands why. That is what makes it an indicator. When silver begins to move in a sustained ways, it is rarely isolated. It is usually connected to broader adjustments taking place across the financial system. Adjustments in liquidity, adjustments in policy expectations, adjustments in currency stability, adjustments in investor behavior. These adjustments are already forming. They are not yet obvious to everyone. They are not fully visible in headline data, but they are present and they are influencing positioning right now. This is where the concept of regime change becomes critical. A regime change is not a single event. It is a process. It begins quietly, it develops through pressure, and eventually it redefines how assets are valued and how capital is allocated. Silver is signaling that this process has already begun. Not at its peak, but at its early stage. And early stages are always the most difficult to interpret. They contain conflicting signals. They create hesitation. They challenge existing frameworks.